Do you want to start investing but feel overwhelmed with all the financial jargon out there? Sometimes you'll hear some financial terms and they will just not make any sense. However, the truth is, they aren't as complicated as we always think. It's understandable if you feel daunted by complex financial jargon, but there are a few ones that can be crucial to your investment journey and help you make informed decisions. In this video, I'll be breaking down some of these terms for you, so stick around to the end and I promise you, you will be in a much better position to begin your investment journey. Ready? Perfect. We will start with the compound annual growth rate, or CAGR. CAGR is a way to measure the growth of a business or an investment over a period. The most important aspect of CAGR is the effect of compounding, which implies that the growth builds upon itself. In other words, if you've invested in a stock or a fund, for instance, and you want to know the average rate of growth each year, CAGR gives you a smooth, annualized rate of return. You'd be able to ascertain if your investment grew at a steady or slow pace. To calculate CAGR, here is the formula to help you understand it better. The ending balance is the value of the investment at the end of an investment period. Beginning balance is the value of the investment at the beginning of an investment period, and N is the number of years you have invested. Therefore, if, for instance, you invested $1,000 and after 5 years it's worth $1,610, the CAGR would be about 10%. CAGR offers a lot of advantages, including helping you to evaluate investment opportunities as well as assessing the historical performance of investments. With that knowledge, you'd be able to compare different investments consistently and make informed decisions. In short, CAGR helps you to measure and understand the steady growth of your money over time. Next, let's talk about return on investment, or ROI. As the name implies, return on investment, ROI, is a financial metric whereby you measure how much profit or loss you've made on an investment relative to how much you invested. In other words, ROI helps you to determine the efficiency of your investment, usually in terms of percentage. To calculate ROI, you divide the net income from an investment by the original cost of the investment, then you multiply the result by 100. Here is the formula. This method has remained fundamental in assessing how profitable traditional investments are. Let's assume you invested $1,000 and made $200 in profit. Your ROI would be 20%. Here's another example. As an investor, you invest $10,000 into a venture without any associated costs. If the company's net profits are $15,000, the ROI would be 150%. You can use ROI to compare investment returns between organizations. Then we move on to liquidity. Liquidity refers to how quickly you can convert an asset into cash while also maintaining price stability. In other words, if you have an asset whose true or fundamental value is $1,000 and you can instantly convert that asset into $1,000 worth of cash, then we think of the market for that particular asset as perfectly liquid. Cash is the most liquid asset, unlike real estate. In such a scenario, real estate would be considered less liquid because it takes time to sell and convert it into cash. Usually, to calculate liquidity, you take the volume of trades or the volume of pending trades on the market at that point. In the case of a significant level of trading activity with high supply and demand for an asset, liquidity is considered high because it is easy to find a buyer or seller. On the other side, if there are only a few participants in the market trading infrequently, then liquidity is considered to be low, otherwise known as an illiquid market. Market liquidity is important for numerous reasons. Apart from enabling you to quickly open and close positions, liquidity has limited associated risks, as there is always someone willing to take the other side of a given position. With such favorable conditions, more traders are attracted to the market. Also, in a liquid market, you don't have to reduce the price of an asset to make it attractive to buyers, and buyers also won't have to raise the price to acquire the asset they want. Please like and subscribe if you like the videos and share with your friends and colleagues. Now, let's discuss diversification. Diversification is a risk management strategy whereby you spread your investments across different assets such as stocks, bonds, and real estate. The idea behind diversification is that you don't want to put all your eggs in one basket, in which case you're less likely to suffer a huge loss in case one investment performs poorly. But there is one thing you need to understand: diversification doesn't guarantee against loss. However, it helps you to reach long-range financial goals while minimizing risk. Here is an example. If you have an investment portfolio consisting of only airline stocks, it is expected that negative news, such as an indefinite pilot strike, will result in a drop in share prices of the stocks. In essence, your portfolio will also reduce in value. However, to minimize your risk, you can counterbalance the airline stocks with a few railway stocks. There's a good chance that the prices of railroad stocks will rise as soon as passengers consider it as an alternative mode of transportation. This is a simple yet effective illustration of diversification. Therefore, instead of making attempts to maximize your returns by solely investing in what you consider the most profitable company, diversifying helps you to put up a defensive position against significant losses. We also have compound interest. Compound interest is the interest you earn on both your initial investment and the interest that has already been added to it from previous periods. In short, it's interest on interest, and it's one of the most powerful tools for growing wealth over time. To calculate compound interest, this is the formula, where P equals sign principal, I equals sign annual interest rate, N equals sign number of compounding periods. For example, if you invest $1,000 at a 5% interest rate, after the first year, you'll have $1,050. In the second year, you'll earn interest on $1,050, and so on. Another way to estimate your compound interest is what is called the rule of 72. If you know the interest rate of an investment, you can tell how long your investment will double in value using the rule of 72. All you need to do is divide the number 72 by your investment's expected rate of return, that is, interest rate. In the case of an expected rate of return of 9%, for instance, divide 72 by 9, which gives you 8. That means your investment will double in value about every 8 years. In short, compounding effect can significantly boost your investments, especially if you leave your money invested for a long time. Finally, let's talk about bull and bear markets. At first, you'd be forgiven for thinking that bull and bear markets are where they trade animals, but that's not the case. In markets such as cryptocurrency, stocks, or real estate, you'll often come across a bull or bear market. A bull market is a period where the majority of investors are buying and demand outweighs supply. In such a case, prices keep rising and market confidence is at a high. Thus, investors are becoming optimistic. Think of how a bull charges its opponent. With a rise in investor confidence, a positive feedback loop is created, which tends to draw in further investment, thereby causing prices to continue to rise. However, bull markets don't last forever. At some point, investor confidence will begin to decline, which could be triggered by factors such as unfavorable legislation, unforeseen circumstances like the COVID-19 pandemic, etc. At the point when prices move downwards, a bear market is created. Therefore, a bear market is marked by a period when supply is greater than demand, investor confidence is low, and prices are falling. As a result of this decline, investors become pessimistic. Consider this type of market as a bear hibernating. Bear markets can often be difficult to trade in, especially for inexperienced traders. Therefore, to make more informed investment decisions, you need to understand whether a market is in a bull or bear phase. So there we have it. A quick introduction to some essential financial terms. I hope that they help you as you navigate the world of investing. If you found this video helpful, don't forget to like, share, and subscribe for more content.